Hi, I'm James Robinson, and this is my stock pick of the week. This is the fifth and final section on our review of Blackrock. This section is on wealth creation. As I say in the past, I think of wealth creation as the measurement of the job the management is doing in terms of rewarding the shareholders and making them more money. So it has lots of different components. We're going to go through all the components, and it will give you a sense of the job that the management of Blackrock is doing in terms of rewarding our shareholders. Before I go on with the video, if you like these videos and you have an interest in investing in the stocks that I buy, you might want to follow me on Twitter. I don't always have a chance to make a video, especially when I sell a stock, but even sometimes when I make a stock, it takes me a few days to get around to a video. So if you want to know what I'm buying and when I'm buying it, I post that on Twitter as soon as I make a trade. The same thing with when I sell a stock. I also will put articles on there that I find interesting, especially about companies that we're investing in or perhaps companies that I'm thinking about investing in. So my Twitter handle is @RobinsonStocks. Also, if you're enjoying these videos, I'd appreciate it if you would subscribe, if you would like the videos, and or if you have something interesting that you want to bring up or there's some point you want to make, feel free to comment below. I do read all the comments and I try to respond to most of them. So a company has, when looking at the wealth creation for a company, we're trying to figure out how the company is rewarding us, the shareholders. And there's several tools that a company can do to utilize to do that. One of the things that a company can do is to pay dividends, and I do an entire video on dividends, and so you can go watch that video. But another thing that the company can do is to repurchase shares. When a company repurchases shares, the company's taking cash out of the treasury and they're investing shares in the open market. And what that means is that the people who continue to own shares will own a larger percentage of the company, even though they didn't buy more shares. That means they should get a larger percentage of the earnings that will benefit them, and they should have a larger percentage of future dividend payments because in theory, the company will pay either the same amount of dividends to less shareholders, or better yet, even more money to still fewer shareholders. So either way, the shareholder gets rewarded. Also, because the earnings are going up per share, you would expect share prices to go up proportionately. Finally, the market likes companies that buy back shares, and so you get rewarded slightly disproportionately. So buying back shares is something that we like. It's something that you often see for a couple of other reasons. One reason is that management likes it because it makes it easier for them to reach their targets. Oftentimes, management is rewarded on earnings per share growth instead of just earnings growth. And earnings per share will grow up disproportionate to earnings if you're buying back shares. And so management will often utilize this tool. The reason is as shareholders, we don't mind this, even though it's pretty obvious, is because when they buy back shares, it increases the value of our company in a way that is tax advantage relative to dividends. When the company pays me dividends, I have to pay taxes on the dividends. When the company buys back shares, I own a larger percentage of the company and I didn't have any taxable event. So it's kind of a win-win for everybody. So with that sort of preamble, you can see that BlackRock was growing its capital base and thus selling shares until about 2010. But since 2010, that process has stopped, and every year they bought back shares. So usually when I look at these charts and this analysis, I say, what has the company done for the last 10 years? BlackRock is a relatively new company that didn't go public all that long ago. And so I've given them a pass, and I'm going to do the analysis based on 2010 till now, maybe it's 2011 till now. And I'm doing that because I think it's fair to reward the company for the fact that it grew intelligently and then it stopped, and now it's rewarding shareholders. So having looked at that chart, you see that the number of shares has decreased, but what does that really mean? So if you'd owned 10% of BlackRock, so if you had a lot of money and 10 years ago, in 2013 rather, you bought 10% of BlackRock, you would have bought 17.1 million shares. So 17.1 million shares equal to 10% ownership stake in BlackRock. Today, as a result of share repurchases, your 17 million shares today would mean that you've gone from owning 10% of the company to just slightly under 11% of the company. So your ownership in the company has increased by 10%, and you haven't spent any money to do that. If your share, look at it another way, your share in the company earnings, if you own 10% of the company, you would have been entitled to, directly or indirectly, $293 million worth of the company's earnings. Today, that same 10% would be worth $488 million of the company's earnings. So on a per share basis, you went from the company having earnings of about $17.23 per share to the company having earnings of about 28.69 cents per share, and that's a 67% increase. So that's a way of looking at the benefits that have happened as a result of you owning the company since 2013 and the fact that the company's been buying back shares all that time. I hope that makes sense. Another thing that the company can do to increase the wealth of shareholders is simply to increase the wealth of the business. And so we call that stockholders' equity. Stockholders' equity is the total amount of assets the company has minus the total amount of debt. And over time, you'd like to see that number increasing. You don't really want to see it increasing too dramatically because the company, what you really want to have the company do is earning a lot of money on every dollar that they've held. But we also like to see that the company is gradually increasing in value. And here you can see that the company has dramatically increased in value since 2005 and gradually increased in value since 2010. That tells us two things: that the company was in a growth rate from 2005 on, and it needed to accumulate capital to grow the business the way they needed to. But now it's also telling you that the company's managing to continue to grow its earnings without dramatically increasing its equity. So I have no problem with this chart. I think it's great. You see the shareholders' equity is going up, and the equity is going up despite the fact that they're paying out $2 billion a year in dividends, and despite the fact that they've bought back 10% of the company in the last 8 years. So really, really happy with that number. If you follow these videos, you know that one of the single most important things that I look at when I look at a company is its return on assets. The logic here is I like companies that don't need a bunch of capital to generate profits. If a company is very capital intensive, that means that a bunch of money every year is going to be used to reinvest in replacing that capital as it gets worn out. Usually that money is for factories and equipment. And that tends to wear out, so you continue to have to pump money back into the company. I like companies that need very little capital to earn a profit. So one of the ways that we look at that is return on assets. And I like companies that are return on assets, certainly in the top 25%, but often at the very least better than that in the top 10% of companies. So here you see this company being very, very average on return on assets. And so you'll say to yourself, well, why is that? Why would I buy in this company in that case? And the fact is that this company has some accounting issues that I need to explain a little bit. This company has something called goodwill, and it has about $14 billion in goodwill, and has about $31 billion of intangible assets. Intangible assets are assets that you can't touch or feel. They don't really exist, but they're an accounting, if you want to, they're sort of an accounting gimmick. So if you had a patent, for example, that might be an intangible asset. And that patent actually might be something you could sell, and therefore it would be an asset, but oftentimes it's not something you can sell. Goodwill is very much not something you can sell. Goodwill is also an accounting gimmick. What goodwill is goodwill is derived whenever you purchase something. So if you purchase a business, and let's say that business has $50 million of assets. Let's say the business has $65 billion in hard, tangible assets that you can touch. So you buy the business and you buy it for $100 billion. So when the accountant looks at it, he goes, well, wait a minute, you spent $100 billion, and all you got was $65 billion of assets. Where's the other $35 billion? And the $35 billion is determined to be goodwill. It's derived. It's the purchase price minus the value of the assets. That $35 billion in goodwill may or may not be legitimate. It may or may not have a value. It doesn't matter. It's an accounting tool. Now, if you were to buy Coca-Cola, you might argue that the Coca-Cola brand actually does have a value, and that's why you would pay more than the value of its assets. If you were to buy Wells Fargo, another example, you'd say, well, that brand has a real value. But that's not really what's important. What's important is that those assets are on the books and they're not generating income, and so your return on assets is mitigated and reduced by the value of those intangible assets. And so because BlackRock has a tremendous amount of intangible assets and goodwill, their return on assets is not very high. If you looked at the return on tangible assets, the return on cash and marketable securities and property and equipment, their number would easily be in the top, probably 10%. So I'm giving them a pass for the fact that they have low return on assets, because I've done the homework to understand that they have all these intangible assets like goodwill. Another thing to know is that goodwill over time erodes, that goodwill over time is depreciated out of the company. And so eventually that asset won't be there anymore. So that's sort of a primer on goodwill. Now maybe I'll post an article on what exactly goodwill is on Twitter so that you can get a better understanding of it. So another thing that I look at is return on shareholders' equity. Return on shareholders' equity is different than assets in that you typically have, let's just say the company has, again, $100 billion in assets. If they had $35 billion in debt, they'd have $65 billion of shareholder equity. So you tend to see return on shareholder equity to be much higher than return on assets because shareholders' equity is a lower number if you follow that math. But again, here we've got all these intangible assets that are screwing up our numbers for shareholders' equity. And so while the company is slightly below average, I don't really think it is actually below average in terms of how well they're doing with the actual cash of mine that they're holding to run the business. So we're going to, without belaboring the point, we're going to sort of give them a pass on that issue, just like we gave them a pass on return on assets. So I've talked about it before. There are a number of things that a company can do with their profits, right? The company can use the profits and they can hoard it in cash. They can pay off debt. They can buy back shares. They can pay dividends, or they can, and often have to, retain some portion of their earnings to invest back in the business. That's called retained earnings. I like companies that don't require a lot of retained earnings because it's money that we never see again. But for companies that are retaining earnings, I like to look at what's happening as a result of that. So here you can see the retained earnings for the company. The good news is the retained earnings for the company have been effectively flat really the entire time this company's run their business. That means they don't require a lot of retained earnings. By the way, this was sort of what really got to me when I looked at this company in the first place. I saw that the return on assets was so low, but I had seen that the retained earnings was very low, and I'm going, well, if they're not retaining anything, where are all these assets coming from? And that's what led me to do the research and figure out that they had all that goodwill. So if you start to look at these numbers with, all the time, you do start to see patterns, and you do start to say, well, that doesn't make sense. Well, what's going on here? And then you can kind of do some research and get to the bottom of it. So retained earnings for the company are very, very low, which means in theory, if the earnings are going up and we're not retaining very many earnings, over time, our return on assets should be getting better and better and better. And when that wasn't happening, I had to figure out why. And that was sort of the research. The next thing that I look at is return on retained earnings. So when a company is retaining money, I like to know, is the money they're retaining being used efficiently? And by efficiently, I mean, is it creating more profits for us? There's not an easy way to do that, and there's probably very complex ways to do that, which I'm not maybe sophisticated enough to understand. So I just use a simple shorthand, which may or may not be very accurate, but it does give me a sense. What I say is, if you look at what this company's retained in earnings for a 10-year period, how much did the profits go up over that 10-year period? And I've really sort of probably erroneously said, let's just apply 100% of that earnings increase to the return on retained, to the amount of money that they retained. And that gives me a sense, are they efficiently using the money they're retaining? Or at least is the money they're retaining getting rewarded enough through whatever activities to make it so I don't care? And you can see this company has done a great job. Back in the past, it was getting these outlandishly high returns on retained earnings. That's because the company was in a fantastic growth rate and doesn't retain much money. But as the company has matured, you would expect that number to normalize, which is what's been happening. But now it's still far above my 10% minimum requirement for return on retained earnings. And all that tells me is I don't need to spend a lot of time worrying about this company's retained earnings. The growth rate relative to the retained earnings is enough that I'm not going to be bothered with what they're retaining. I talk about this in the balance sheet section, but one of the things that happens that the company does to reward its shareholders is to retain cash. When a company retains cash, there are lots of benefits. First of all, if a company's paying dividends and buying back shares and retaining cash, that tells me the company's pretty profitable, right? They're able to do all these things. They're retaining earnings to some degree, which means they're investing money back in the business. They are paying dividends. They are buying back stock, and there's still cash left, and that cash is accumulating. That's a really good sign. That means this company is really spewing out money. When a company retains cash, as long as they don't retain too much, it means they have a war chest to go out and buy companies when they're distressed, to deal with things like the coronavirus when it happens, without running off to the bank when everyone else is running to the bank. It means they have the ability to pay off their debt should they choose to do it. So I really do like companies that are retaining cash. I don't want to retain too much cash because the goal is not to enrich the company, the goal is to enrich the shareholders. But retaining some cash, I don't mind, and I actually reward the company for that as I analyze it. So you can see that the blue line is actual cash, cash equivalents, and marketable securities. That number has gone up, but gone up gradually, and again, gone up less dramatically than earnings. So they're retaining cash, but not disproportionate to their growth. Then you can see investment in advances. That's gone up pretty well as well. That means that the company is utilizing its cash and putting it to work intelligently. I like that. And so the total reserves for this company have grown fantastically. You might even argue that total reserves for this company are getting too big and they could be rewarding the shareholders even more. Having said that, let's see where this number is in 2 years, because the coronavirus is undoubtedly going to dig into this. And so rather than getting on the company for doing this, maybe we'll assume that they were being reasonable and prudent, and we'll see that this number sort of normalizes itself as we go through what inevitably is going to be recession through the coronavirus. So this is my favorite chart in looking at total wealth created. What I've really done here is I've said, okay, we've talked about all the ways the company can reward the shareholders. They can hoard some cash, they can pay off debt, they can pay dividends, they can buy back stock. So I add all that up and I say, some years they're going to pay more in dividends and maybe even have a net borrowing of money, and they're going to have more money in cash or less money in cash. It all sort of balances out. And so I chart all of those things. You can see it sort of looks like spaghetti, but if you look closely, you can get a sense for what's happening. And then I say wealth created on an annual basis, which is the summation of these categories. And then I say wealth created, the orange line is cumulative wealth created over the last 5 years. And what I really like to see is that number going up, and you can see that it really is. And my supposition is that as that number goes up, so does our share price and so does the wealth of us, the shareholders. And for this company, you can see that it's very, very, very safe. So I love this company. I think this is a really, really well-run company. I can advise you to buy it without reservations. We see that the cash is doing well. We know that the debt isn't a problem. We know that the earnings are growing. We know they're getting good returns on retained earnings. They're buying back shares. They're paying back dividends, yada, yada, yada. Why haven't you guys already bought this stock? So that's it for Blackrock. And the next slide, we're going to talk about our portfolio and what's been happening in our portfolio, which is frankly not so great. But obviously the coronavirus is a big problem with that, and hopefully that will be correcting itself over time. So here you can see the chart of what's happened so far this year. Starting with Gilead, we bought Gilead and then turned around and sold it, made a nice profit on it. It turns out if we'd continued to own it, we might have done better. I didn't know there was going to be a coronavirus. I didn't know that Gilead was going to supposedly have a potential solution to that, which is going to make their stock price do well. But you can't go broke taking a profit, and we did. We made 16% on it. Great. MSM, we bought, and we were doing well on it. And I bought it because there was a special dividend, which is going to pay out a nice chunk of change to us. I did that. I bought way too much of it, frankly, and the coronavirus struck, and it kind of slapped me down a little bit, which is one of the reasons, in fact, the reason that I'm not performing better relative to the S&P 500. But that is what it is. It's you can't cry over spilled milk, and you learn your lessons and you go on. And I want to address that. There's going to be stocks that you will buy in your career that are going to perform poorly. You've done your homework, you've researched, you analyzed it, and something just went wrong. And that's part of the game. There's also going to be stocks that you buy and they really outperform. They get taken over, and they did way better than you thought they would ever do. As investors, we tend to take credit for the ones that are home runs, and we tend to blame someone else for the ones that are failures. The fact is, you're as good as your average stock. You're not as good as your bad one. You're not as good as your great ones, and you're not as bad as your bad ones. There's going to be some opportunities to lose money in this business, and you just have to sort of accept it, and you have to try and learn from it and move on and not get too disgruntled or too disheartened when it happens. So having said all that, you can look at the charts, the stocks that we owned before the coronavirus hit, and like everybody in the market, we've gotten hammered pretty badly, actually. We've got stocks down 30 and 40%. I continue to hold those stocks because I believe they're going to come back. I believe they're going to outperform the market in the long run, and a few months is not the long run. A few bright spots: Warner Enterprises is up about 8%. Warner's a trucker. You can imagine that there's an awful lot of food and toilet paper being shipped around the country, and so those guys are doing okay. And then if you look at the stocks that we bought since the coronavirus has hit, and I bought, looks like 1, 2, 3, 4, 5, we bought 6 positions since then. They're all up, and they're up significantly. Children's Place is up 60% since I bought more. SEIC is up 14%, and Ventas is up 35%. The problem with those stocks is that I didn't invest as much money in those as I have in other positions. I'm out of money, I'm fully invested. And because I'm fully invested, I had very little in reserves to invest in these stocks. The reason that I sold rather MSM is because I think MSM will rebound. I just thought these stocks would rebound faster. And so I did that so I would have some capital to reinvest. So I've learned some lessons through this. I've learned that we should have reserves. I've learned that I should be more disciplined in terms of not investing too big on my portfolio in one stock. I mean, I wasn't way out of line, but I think I had 30% of my money in MSM at one point. So that was a bit of a mistake. Long story short, I'm down about 23% for the year. That's before adding in my dividends for the month of April. The S&P 500 as I stand today is down about 15%. So I am being outperformed by the S&P 500, which really bothers me. I'd like to believe by the end of the year that will rectify, but this is where we are today, and I try to be completely honest with you guys. So that's where we are. Hopefully things will do better. Strange times. I see that gasoline and oil, I should say, is actually trading at negative dollars. It's unbelievable, frankly. I had to really get online to read an article to understand how something could trade at negative. For those of you who are interested, if you have an oil futures contract, at the end of the contract, you either have to sell that contract or you are obligated to take possession of that oil. And the problem is there's no place to put it. There's no place to store the oil. We're not using much gas while we drive. And as a result of not using much gas while we drive, we're not using much oil. And that means that the oil reserves are filling up all the oil tanks. And if all the oil tanks are full and you've got an obligation to take 1 million barrels of oil, you got nowhere to put it. And you can't just pour it out. And so people are literally having to pay other people to take their oil off their hands, which is, I mean, I'm sure people are getting destroyed and bankrupted over it, but it's fascinating. Anyways, that's it for Blackrock. And again, if you like these videos, please subscribe. It's the only thing I'm getting out of this. I'm doing it for fun. And also, if you are watching these videos, if you don't mind and you subscribe, I'd love to hear where you're from. I've got a map I've shown in some of my videos of people who've subscribed and told me where they're from. And it kind of gives me a charge to see that, somebody just joined up from Shanghai. Wow, that's cool. So just put what city and country you're from. I'd appreciate it. Thanks a lot for your time.